Okay, this video covers the basics of financial accounting. We'll go through the purpose of financial accounting, then we'll talk about kind of the public company reporting environment, and finally we'll talk about the mechanics of accounting, so journal entries and T accounts. And I'm going to share my screen and disappear this time. So we're talking about the basics of financial accounting. And first I'll say the purpose of accounting and financial accounting is to be able to make statements about the financial position and operating performance of an entity, and specifically a business entity. So we want to make statements. And let's first talk about financial position. Financial position is probably a pretty familiar term. It kind of refers to how many resources does the entity have, another word for assets. It could also refer to how many obligations does the company have, which is another word for liabilities. So how many resources does the company have? Is it enough to cover its obligations? And if it's more than what it needs to cover its obligations, then whoever owns the business has some equity in the business. And so the financial position is kind of describing the balance sheet. The assets of the balance sheet are the resources, the liabilities are the obligations, and the equity section of the balance sheet is whatever's left over after the firm would use its assets to pay off its liabilities. The second term is operating performance. So what does the operating performance mean? Well, the operating performance refers to a period of time. And so this term is kind of referring to the income statement and also the cash flow statement in a way. And so operating performance is how well is the company improving its financial position over time. So over the past year, has the company improved its financial position, or has its financial position gotten worse? And you can tell that by seeing how much revenues the company is generating relative to how much costs the company is incurring. And if the company is generating more revenues than it's incurring costs, then the company is generating a profit and it's increasing its financial position over time. Okay, so the purpose of the financial statements is to make these statements about financial position and operating performance. In fact, the Statement of Financial Accounting Concepts, which is kind of like the organizing principles of accounting rules, says that financial reporting should provide information that is useful to the present and potential investors and creditors and other users in making rational investment, credit, and similar decisions. So is the information that we're providing investors about financial position and operating performance, is it useful for them to make important decisions about whether to invest in the company, whether to sell their investment in the company? Credit means whether to lend money to the company. And similar decisions means if I'm a manager and I'm trying to decide which segment to invest in, accounting information can help me make that decision, which segment has the most potential to generate good financial performance. Okay, so financial accounting provides a mechanism for firms to communicate with outsiders, communicate useful information that the outsiders can understand. So now let's consider the financial reporting environment, and I'll use an example of a company called Palantir, which is currently a private company, and they're probably contemplating going public. And so for now, though, it's a private company. And so put yourselves in the shoes of a sophisticated investor who is investing in Palantir. And ask yourself the question, do you need them to provide you any information so that you can keep track of your investment? Are you interested to know if you've invested money, if you've given your money to Palantir and you want them to generate a return on that investment? What information do you need to know about Palantir to know that they're using your money wisely? And so the point that I'm trying to get at is that even without required rules and regulations, sophisticated investors are going to want useful information before they'd be willing to give their money to Palantir, either through ownership or lend their money to Palantir through a credit arrangement. And so accounting rules actually would come about even in the absence of rules and regulations. The point for public companies is once there are huge numbers of people, and in particular, huge numbers of not financially sophisticated people who are willing to invest their money in a company like Palantir, well, then we need rules and regulations, because unsophisticated investors are thought to not be able to take care of themselves as much as sophisticated investors. And so that's when government regulation steps in. So the Securities and Exchange Commission, their main reason for existing is to protect investors' interests. And that means to require companies to provide certain information to investors, and to ask important questions to companies when it seems that their financial information isn't complying with accounting rules. And the Securities and Exchange Commission is also in charge of setting the accounting rules. So they get to decide what accounting rules public companies are required to follow. And so a company becomes public when when it has lots of investors, or it's large in size. Then it becomes public and it becomes regulated by the Securities and Exchange Commission. And also the PCAOB is the second one, the Public Company Accounting Oversight Board. And that entity requires each public company that files financial statements with the SEC, those financial statements have to be audited by an independent registered public accounting firm. And that means that an independent third party, and the popular names of these accounting firms are PricewaterhouseCoopers, PwC, Deloitte and Touche, KPMG, and Ernst & Young. Those are the big four public company auditors, and there are many others. And they are an independent, they're supposed to be independent, so they don't have any financial ties with the company filing financial statements. And they provide an opinion on the financial statements, saying that they're free of misstatement. So they are okay for investors to rely upon. Of course, the one kind of conflict of interest is that companies are responsible for paying the auditor's fees. So even though the auditor is supposed to be an independent registered public accounting firm, they're actually being paid by the company that they are auditing. So that's a bit of an independence issue, but that's the current rules in place in the US. Okay, so the SEC, the Securities Exchange Commission, and the PCAOB. And the SEC requires public companies to report financial information publicly, and the PCAOB requires public companies to have financial statements independently audited. And I have a separate video going through all of the different filings that the SEC requires public companies to make. And I'll just breeze through them now. Registration statements, companies are required to file those when they're first issuing securities. So if they want to do a sale of securities, whether it be debt or equity securities, to investors, they have to file registration statement, which kind of has financial statements in it. It also talks about the risk factors involved so that investors know what they're getting themselves into when they invest in a company. SEC requires companies to file quarterly financial statements. So a quarter is 1/4 of a year. So it's 3 months long. There are 4 quarters in a year. And quarterly financial statements are typically filed on Form 10Q, and they're due 40 to 45 calendar days after the balance sheet date. So after the period ends, companies have 40 to 45 calendar days to file their 10Q. And companies file a 10Q for the first quarter, second quarter, and third quarter. So that's typically the quarters ending March 30th, June 30th, and September 30th. Okay, so the annual financial statements is filed on Form 10K for United States issuers, 20F for foreign issuers, and 40F for Canadian firms. And the 10K is just for the fourth quarter, but the financial statements and footnotes in the 10K cover the entire fiscal year. So that document is larger, and so companies have more time to produce it. They have 60 to 90 calendar days after the Q4 balance sheet date to file their 10K with the SEC. And the 10K contains financial statements and internal controls, and the financial statements and internal controls are both audited by the independent registered public accounting firm. Internal controls, by the way, are just the systems and processes in place to produce the financial statements and footnotes. So if they're operating effectively, then this financial statement should be free of errors. And internal controls are designed to prevent and detect material errors and fraud. and prevent that from infecting the financial statements. Okay, when material unscheduled events happen, like a merger is happening or a bankruptcy or a significant new agreement, a company will file an 8K, or a 6K if it's a foreign issuer. Those are generally due 4 days after the event. Material contracts are attached as exhibits to these 8Ks. So if the company signs a material contract, it's got to be attached to the filing. Shareholder meeting materials. So every year, public companies are required to have shareholder meetings where shareholders can vote on things such as executive compensation or mergers or environmental matters, or, matters that are important to shareholders. They get to vote on it, including the most important of all probably is that they elect board members. So shareholders elect people to serve on the board of the company. And the board is responsible for setting compensation, hiring executives, and making key strategic decisions. So shareholder meetings, companies inform shareholders what they'll be voting on and other relevant details, and they inform them in a Def 14A. And then other filings are Pre-14A and Def M14A. Those are just depending on what type of a shareholder meeting it is. The final form is for insider trades, and that's a Form 4. So insiders such as the CEO and CFO and major executives are required to disclose when they buy or sell securities of the company. So investors are interested to know whether the CEO is dumping shares or the CEO is picking up new shares. The investors are interested to know that. So CEOs have to file their trades on a Form 4. Okay, so U.S. financial accounting rules. That's what this course is all about. Each session that we'll have, we'll talk about a different area of the financial statements and what are the rules for accounting for that area. And who sets the rules? Well, the SEC is responsible for the rules, but the SEC delegated authority for rulemaking to the FASB, the Financial Accounting and Standards Board. It was established in 1973. It's independent. It's a private sector board. It's not for profit organization. It's in Connecticut, and it establishes the financial accounting and reporting standards for public and private companies and not-for-profit organizations. And it defines what is considered generally accepted accounting principles, or GAAP. So in this course, I'll refer to GAAP or US GAAP, and that refers to the accounting rules that companies are required to comply with, especially if they're public. They're required to comply with these rules when they determine what journal entries they make and when they produce their financial statements. Okay, so now we're going to go through the accounting mechanics, so the journal entries and T accounts. First, let me tell you all the different types of accounts that we have. So the word account refers to just a unit of the accounting system where we want to keep track of a balance. So things that we want to keep track of. When business started back in the caveman and cavewoman days, it was probably just on the cash basis. So companies were interested to know how much cash they had in the bank account. And they might also be interested to know the change in the cash balance. So did our cash balance go up this period or go down this period? And so the cash, let me see if I can get the laser pointer going on here. So the cash balance was the original account, okay? But then we as a society determined that it's useful to keep track of more information than just the cash balance, because sometimes we earn money, but we haven't received the cash yet. Also, sometimes we receive cash, but we haven't really earned it yet. And other, things like that. And all those things are called accruals, which means the word accrual, and this is called, there's a cash basis of accounting and there's an accrual basis of accounting. And the accrual basis of accounting recognizes the idea that the cash flow sometimes occurs at a different time from the economic activity. So sometimes firms earn something before they receive cash. Sometimes firms incur an expense before they actually have to pay for it. Sometimes companies prepay expenses before they have actually incurred it. So prepaid rent, for example, we're going to pay rent ahead of time, but we don't really owe rent until later. So these accounts are all meant to keep track of those accruals, okay? That's what all these balance sheet and income statement accounts are meant to do. So there are 5 categories of accounts: assets, liabilities, and equity. Those are all balance sheet accounts. And then income and expenses. Those are all income statement accounts. So asset accounts, cash, inventory, accounts receivable, prepaid expenses, PP&E, and many others. Those are all asset accounts. They represent, what is an asset? An asset is a probable future economic benefit to the owners of the company. And so cash is a future economic benefit because hopefully it's paid out in dividends when the company doesn't need it anymore. Inventory is a future economic benefit because we can sell it for more than it cost us to make it. Accounts receivable is a future economic benefit because customers are going to pay us cash in the future, and hopefully we can pay out that cash as a dividend. Prepaid expenses are a future economic benefit. So for example, in the case of rent, the future economic benefit is being able to occupy a office space in the future. So that's the future economic benefit there. And so all the assets have future economic benefits. And when we keep track of what is the basis for that asset, what is its value, we keep track of that with a debit. So the normal balance in those accounts is going to be something called a debit. And that's all I'll say for now about a debit. Okay, liabilities. Liabilities are future economic sacrifices of the company. So accounts payable means that the company has to pay some of this cash out to its suppliers in the future. So that's a future economic sacrifice. Deferred revenue means that we've received some cash, but we haven't earned it yet. So we need to provide some good or service to our customer in the future. Debt is an economic sacrifice because we're going to need to make interest payments and a maturity payment to settle our debt contract because we've borrowed cash. Debt means we've borrowed cash and we need to pay it back in the future. So that's a future economic sacrifice. And we keep track of these liabilities using a credit balance in the liability accounts. So the normal balance for a liability account is a credit. Equity accounts is whatever is left over after you use all your assets to pay off all of your liabilities. What's left over is equity. So that's what the owners have left in the business. If it were to wind down and liquidate, that's what the owners would have left. Common stock is what the owners initially contributed to the business in terms of their, and also additional paid in capital. So these two accounts together is what the original owners contributed to the business in terms of financing the business with equity capital. Retained earnings is the cumulative life-to-date net income minus dividends that the company has had over its entire lifetime. So it literally think of retained earnings. So earnings is going to be net income, and it's retained if and only if the company does not pay it out as a dividend. And so that's what retained earnings represents. Okay, so equity accounts are also kept track of with a credit, and that's because assets equals liabilities plus equity. And so debits equals credits. And so that's why we keep track of assets with a debit and we keep track of liabilities with a credit. It's because assets have to equal liabilities plus equity. So when we make future journal entries and the debits and the credits are equal in the journal entries, we know for a fact it will maintain this balance sheet equation of assets equaling liabilities plus equity. Okay, the income statement account, there's sales. So in terms of income, that's good for the business. That's an increase in the financial position of the business, and that can be through in the form of sales, which is selling your main products and services to customers. Other income, which could be like if they're using some of this cash to just invest in a money market mutual fund or some other portfolio, you might have investment income. That's not the primary purpose of the business, but that income shows up on the income statement. You can also have gains, and these are typically if you sell an asset. So if you have PP&E and then you sell it for a gain, you will show that gain on your income statement here. But that's not sales. I mean, we're not in business to sell PP&E. We're in business to sell inventory. Okay, in terms of expenses, there's cost of goods sold. So that is what the inventory, so you sold the inventory and you generated sales, but what was the cost of the inventory that you sold? So you transfer the costs from the inventory balance into the cost of goods sold balance. Depreciation expense is charging your assets. You you recognize the cost of those assets over time in your income statement. And then losses is the same thing. If you were to sell PP&E for a loss, you would recognize that on your income statement. So in terms of debits and credits, income, so good things for the business, when good things happen for the business, we credit an income account or an income statement account. Why is it a credit to an income statement account? Well, a credit in the income statement account is closed to retained earnings after each accounting period. So once we measure financial performance for the period, we close all of these accounts into retained earnings. So the credit in the income statement becomes a credit in retained earnings. And so this becomes more equity for the owners of the business. So that's why sales and income and gains and good things that happen for the company are credits. That's so we keep track of these accounts with a credit. Expenses, costs of goods sold, depreciation expense, and losses, well, these reduce the owner's equity. And so when these get transferred into retained earnings at the end of an accounting period in the closing entry, these debits become debits in retained earnings, and they reduce the equity account retained earnings. Okay, so that's kind of these are kind of examples of accounts, but these are all the different categories of accounts that you will have and the normal balance that you should see in that account. And we keep track of the balance using T accounts, which we'll get to on the next slide. So then this slide talks about journal entries and T accounts. Journal entries are entries, and we record them when economic events occur, and we also sometimes record them when a period end happens, and we need to fix certain balances for year-end reporting, period-end reporting purposes. So a journal entry is just an entry into a journal. It has the account name that you're making the entry to. It has the amount that you're making the entry and whether it's a debit or a credit. And journal entries need to have the same amount of debits as they have credits, okay? So so in terms of what the journal entry looks like, the convention is that the debits are reported first, followed by credits, which are slightly right indented, as you can see here. So let's do an example transaction. So this is an economic event. The company is receiving a prepayment from a customer. So the first thing you should always do when you think about an economic event and you want to know the journal entry, ask yourself if cash is involved. And in this case, cash is involved. The company is receiving a prepayment of cash. So the company is receiving cash. They need to increase the cash account. We increase a cash account with a debit. So in the journal entry, we'll have a debit to the cash account. And I've just made up the number of $20 for a customer prepayment. And in a journal entry, so that's the debit. In a journal entry, the debits need to equal the credits. So we need a credit in this journal entry. So here's where the kind of thinking comes into place of where should the credit be? When we've debited cash, where is the credit? Well, we haven't earned this payment from our customer yet. It's not yet sales revenue. In other words, it's not yet financial performance of the company, okay? It hasn't increased our financial position because we haven't earned it yet. So the customer could require it back from us. So rather than recording it as sales revenue, we're going to record it as a liability account on the balance sheet. So we're keeping track of it, but we're keeping track of it on the balance sheet as an accrual called deferred revenue, a liability account. And that represents the obligation to deliver the service or product to the customer in the future. And the value of the obligation is $20. Okay, so that is a journal entry. You record these when events occur or period ends occur. And you need to true up certain accrual accounts to make sure the income statement represents all the costs that you've incurred during the period and so on. Okay, so now let's talk about T accounts. T accounts are the ones that have balances. And the balance of a T account will typically show up on the normal side of the account. So we talked about normal in the previous slide. So normal mentioned in this previous slide. So T accounts have balances, and typically on the normal side. Journal entries up here are posted to T accounts, and they affect the balances. So for example, let's post the above journal entries to the T accounts. So let's first consider the cash T account. So cash is an account, it's an asset account, and it has a normal debit balance. So I just put a beginning balance in here in its normal position. I made up this $100. So the company had $100 to begin with. Then they received cash from a prepayment of a customer. So they debited the cash account. So that $20 debit posts to the account just like this. And the debit side is on the left and the credit side is on the right. So it posted right to the debit side of this account. And so the beginning balance was 100, but now the ending balance is 120 because that journal entry was posted. And what auditors are going to do, an auditor is going to look at $120 and make sure that that agrees to the bank statement, to make sure the bank statement also said $120. That way the cash account is stated correctly. Okay, next we'll post the deferred revenue balance here. So deferred revenue is a liability and it has a normal credit balance. So I put a beginning balance in this account of $10. And now I'm posting this $20 additional to the account. And so it's got an ending balance of $30. And so we're keeping track of deferred revenue because we want to know how much of this cash that we've collected, how much of that have we collected but not really earned yet? We still owe customers $30 worth of goods or services. So that's the deferred revenue T account. That's what that looks like. Okay, now finally we'll go through the accounting process. So during an accounting period, which could either be a quarter if you're producing quarterly financial statements, or a year if you're in a company that only produces annual financial statements like Mogen. And so the first step is you have a general journal and you record general journal entries as transactions occur. So we just recorded that receiving cash as a prepayment from a customer. That's just a transaction, and we recorded it as it occurred. We record those all during the year. Step 2 is you arrive at the time of year that you need to report financial statements. So either you've arrived at a quarter end or a year end, and you need to produce a balance sheet and an income statement. Step 3 is to record adjusting journal entries as necessary. For example, maybe you prepaid rent at the beginning of the year, and now it's the end of the year, and we need to transfer some of that prepaid rent, which is sitting in an asset account called prepaid rent, into rent expense on the income statement. So right now it's a debit in the prepaid rent account. We need to transfer that debit into the income statement to be a debit in rent expense. Okay, so that would be an adjusting journal entry that you only record when you need to produce an accurate income statement, for example. Step 3 is to now you're ready to report an income statement. So because you've did these adjusted journal entries, so all of your income and expenses are correct now, and now you can just report them on your income statement. Your income statement has income minus expenses, and then that equals net income. So that's step 4. Step 5 is to record a closing entry. So all of these income and expense accounts, we're going to close them into retained earnings. So this debit, for example, in rent expense is going to become a debit in retained earnings. And any credits that we had from making sales are going to become credits in retained earnings. And if the credits are greater than the debits on the income statement, we're going to have positive net income, and we're going to increase our retained earnings this year, because the credits posted to the retained earnings account are going to be more than the debits posted to the retained earnings account. So that's step 5, is recording the closing journal entry. And once you've done that and the retained earnings account is now correct for the end of the year, you're ready to report the balance sheet. Your assets and liabilities are ready, they have been correct after the adjusting journal entries, but now your equity is correct because you've posted the closing entry to the retained earnings account. So your assets and liabilities and equity accounts are ready to be reported to investors. And then once you've reported the balance sheet, it's over. You're totally done with the accounting process for that period of time, and you're ready for the next period of time to start recording general journal entries again as transactions occur. Okay, so that's what I wanted to share with you. So we went through quite a lot there. That was a long video. And we went through the kind of idea behind financial accounting. We went through the government entities that step in when a company becomes so big that the government needs to protect these unsophisticated investors. That's the SEC and PCAOB. And we learned about what filings are required, and we learned that auditors are required to check those filings to make sure they're accurate. Then we learned about the accounting mechanics. So we learned about all the different accounts and their normal balances and why we keep track of these accounts. Then we learned about journal entries. Journal entries are what affect the balances in those accounts. And those accounts are kept track of using T accounts with a debit side and a credit side. And the journal entries are posted to those T accounts. So a debit journal entry is posted to the debit side of that account's T account, and a credit is posted to the credit side. And then we talked about the accounting process. So starting with recording general journal entries all the way through the closing entry. Okay, so I hope you enjoyed that video. It was a long one, so I hope you'll go back and kind of look at things that were less clear, and I hope you'll ask me questions, ask me follow-up questions if anything wasn't clear for you. Okay, so I'll see you soon, and bye-bye.